Hey guys, it's Adrian here, the Canadian in a t-shirt. And today, I'll be breaking down my top 2 favorite Canadian dividend stocks of all time. I've been investing in these companies for years, and I picked these stocks because they all pay out a generous dividend, they have a long history of increasing their dividends, and they're from different industries, helping you build a diversified portfolio of the Canadian market. The stock market right now is in the middle of a downturn, but I don't care about the short term because these are quality companies with a long-term future. So I'm using this as an opportunity to buy more shares at a discount and lock in even higher dividend yields, as I've talked about in these past videos. These are established and secure stocks that I will hold on to for life and collect that passive income every month or every quarter. So without further ado, my top 2 Canadian dividend stocks are TD and RioCan. And when I say they're my favorites, I mean it. These are some of the first stocks I ever bought almost 10 years ago, and I've never sold them. I believe in transparency and credibility, so I would never recommend a stock that I don't personally own. And looking here at my dividend tracker spreadsheet, you can see that RioCan, TD, and Enbridge are my largest holdings in my TFSA. And that's just my TFSA. On top of that, I also own shares of TD and Enbridge in my margin account. That's because Canadian dividends get preferential tax treatment in a margin or non-registered account, but REITs do not. So I only hold my REITs, like RioCan, in my TFSA to avoid these taxes. I talk about this strategy in greater detail in my members-only videos, where I also reveal my full TFSA and RRSP portfolio. So hit the join button down below to watch these exclusive videos and help support my channel. I'm going to be breaking down why I think these stocks are great choices. So I'll be talking about things like dividends versus capital appreciation, the payout ratio, and the amount to qualify for a DRIP. If you need a refresher on these basics, click the pop-up at the top right to check out my dividend investing guide, and then come back to this video. So with that, let's jump into my all-time favorite dividend stocks in Canada, starting with TD, Toronto Dominion Bank, ticker symbol TD.TO. TD is actually my all-time favorite dividend growth stock, and it's easy to see why. TD is the second largest company in Canada, right behind Royal Bank. You can't get any more established than that. For 2 centuries, TD has been a staple of the Canadian economy and one of the most reliable dividend investments in the world. I love this fact. TD has never missed a dividend payment in 165 years. That's amazing. Even through World War I, World War II, the Great Depression, the housing crash of 2008, the pandemic of 2020, TD always pays out a generous dividend. You can't go wrong investing in any of the 6 big Canadian banks. I personally own shares in all of them because these banks on the Canadian side are so well regulated, far more than they are in the US. That security and reliability makes the Canadian banks some of the best dividend investments in the world. But the reason why I choose TD as my favorite is because they have been aggressively expanding into the United States, and it has certainly paid off. Earlier this year, TD acquired First Horizon Bank, one of the largest banks in the US. This is a $13 billion deal that will close in early 2023, and when that happens, TD will be one of the top 6 banks in the United States. In fact, TD now has more branches in the US than they do in Canada. This is a huge advantage over the rest of the Canadian banks because the United States has almost 9 times the population of Canada. That's a huge market that they have access to and will continue to expand, as I've talked about over the past 3 years. Even on the Canadian front alone, TD is so universal with bank accounts, mortgages, credit cards, insurance, investing, and more. TD has over 17 million customers in Canada. That's 53% of the adult population. That is the definition of a Canadian staple. Because of fears of a recession, high inflation, and rising interest rates, the market as a whole is down, which makes sense. When interest rates rise, that hurts the profits of all companies. But when it comes to the financial sector, higher interest rates can actually help. Banks earn income from mortgages and loans, so when the interest rates rise, that boosts their revenue. Of course, higher interest rates also make it less likely for clients to take on new loans, but for TD's existing loans, this does help their bottom line. It's not quite this simple, but my point is that rising interest rates hurts companies across the board, especially their stock price. But for banks like TD, there is a silver lining, and they can actually benefit from it. That's why I'm using this as an opportunity to buy more shares of TD at a great discount. And with this current drop in their share price, their dividend is even better with a great yield of 4.1% paid out every quarter. In the past 6 months, the share price has dropped by about 20% to a price of $87.20. For me, this is great news. The share price dropped by 20%, but the dividend remained the same. So now I can buy cheaper shares and lock in that higher dividend yield. In fact, TD actually increased their dividend in January by 13%. And even with this higher dividend, TD still has an extremely low payout ratio of 43%, which is incredible. That means that only 43% of its profits go out to investors through dividends, leaving it with 57% of its net income to reinvest in itself and grow as a company and further expand in Canada, the United States, and around the world. Because of this super low payout ratio, TD's dividend is very secure, and we can expect another dividend raise next year. In fact, TD has increased its dividend at an average rate of 11% per year over the past 25 years. That's exactly what I want to see from a long-term dividend stock. And because of this reduced share price, it's now that much easier to qualify for a DRIP with TD. Remember, a DRIP allows you to reinvest your dividend and use it to buy more shares of a company rather than receiving cash. And the best part is, you don't pay any commission at all when you use a DRIP to buy extra shares. This is the best way to invest in the long term, allowing your dividends to compound automatically, giving you true exponential growth. In the case of TD, you'll need about $8,510 right now to qualify for a DRIP. Let's go through the math. With a dividend yield of 4.1%, our $8,510 investment would give us $348 per year in dividends, or $87.22 per quarter. TD currently has a share price of $87.20, so every 3 months, our dividend will allow us to purchase an extra share of TD for free, and then we receive the remaining 2 cents as cash. And yes, $8,500 is a lot of money, but you don't have to reach this DRIP threshold all at once. Just invest what you can and work your way up to it over the course of years. That's what I did. To find out how I calculated this DRIP amount, click the pop-up at the top right to check out my DRIPs explained video, where I go over the long-term benefits of DRIPs and I provide a free Excel spreadsheet to help you calculate the DRIP amount for any stock you want. Looking at the stock price over the past 3 years, you can see an overall upward trend, even with the ups and downs. We had the huge drop in 2020 market crash, but TD was able to recover very quickly and reach new highs. Again, we're in the middle of a market downturn, but if you zoom out over 20 years, you can see this undeniable upward climb, where these massive crashes in the short term are really just small dips in the long term. That's why TD is my favorite dividend growth stock. Not only do I earn consistent and increasing dividends year after year, I also get incredible long-term capital growth. If you're not sure how to actually buy these stocks, click the pop-up at the top right to watch my QUESTRADE tutorial, where I give a step-by-step walkthrough of how to buy stocks and ETFs using QUESTRADE, my favorite online broker. If you'd like to get started with QUESTRADE, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. Next, we move into the real estate sector with one of the largest REITs in Canada, called RioCan, ticker symbol REI.UN.TO. A REIT is a real estate investment trust. This is a collection of hundreds of real estate properties packaged together as a stock. And the rent from all of these properties goes back to investors as dividends or distributions. They're basically a way to tap into the real estate market through the stock market, so you don't need $100,000 for a down payment. Check out my REITs explained videos to learn more. RioCan is actually the second largest REIT in Canada, and they are the largest retail REIT. So they own hundreds of large shopping centers, and their tenants are the individual stores who pay them rent. RioCan focuses on quality retail properties in dense urban areas with high traffic of customers, including both enclosed shopping malls and open-air plazas. Of course, the retail sector was devastated during the 2020 lockdowns, but the good news is that RioCan focuses on essential services. In fact, the majority of RioCan's properties are anchored by grocery stores and pharmacies. Even if we saw another lockdown, these essential businesses would remain open and continue to pay rent. One of RioCan's priorities is attracting quality tenants across the staples of Canadian retail, like Loblaws, Shoppers Drug Mart, Canadian Tire, Walmart, Metro, and Winners. And they keep it diversified. They don't want to be too reliant on any single retailer, so none of their tenants can earn more than 10% of their total revenue. But they do focus geographically on 6 major urban centers: the GTA, Vancouver, Calgary, Edmonton, Ottawa, and Montreal. These 6 cities make up 91% of their revenue, which allows them to concentrate on desirable, high-income neighborhoods with growing populations. Those are the neighborhoods where they're developing massive residential and multi-use complexes. These will be luxury high-rise units with the first few floors reserved for retail, which is a great business model. Those stores will have built-in foot traffic. Of course, these new developments cost money, but ever since stores reopened from lockdowns, RioCan boasts a 97% occupancy rate. That reliable and increasing monthly rent allows RioCan to pay generous dividends every month. And with the recent drop in the share price, their dividend is even better with a fantastic yield of 5.1%. If you buy shares of RioCan right now, you'll be buying them at a 24% discount from just a few months ago, and that's exactly what I'm doing. Rising interest rates hurts the real estate sector as a whole, since these building projects are funded by loans. But with quality and reliable tenants, RioCan is still profitable and will absolutely recover. It's just a matter of time. And once these exciting new developments are complete and open for business, we can also expect significant capital gains. Collecting dividends every month is wonderful, especially when you've locked in a great yield of 5.1%. But I always say, having a large dividend is not enough. We have to make sure it's sustainable. And when it comes to REITs, using a dividend payout ratio is not the best metric. Remember, for my REITs Explained video, I broke down how net income or earnings is not the best way to evaluate a REIT, since it doesn't account for the depreciation of its properties. When it comes to REITs, you should look at the funds from operations, or FFO instead. The FFO is much more representative of the true cash flow of the REIT. So to tell if a dividend is sustainable, we look at the FFO payout ratio. In the case of RioCan, they have an FFO payout ratio of 57%. That's great news, and it's already in line with their target goal of 55 to 65%. This number tells us that only 57% of the income from regular business activities goes out to investors as dividends or distributions, leaving the rest to buy more properties, fund more projects, and expand. Many REITs have an FFO ratio above 90%, so this tells us that RioCan's dividend is definitely sustainable, and if things continue, we can expect another dividend increase within the next year. When the share price takes a dip, I get excited. Not only can I lock in a higher dividend yield, but it makes it that much easier to qualify for a DRIP. You'll only need $4,710 invested to qualify for a DRIP, and this is a monthly DRIP. With a dividend yield of 5.1%, our investment of $4,710 would give us $240 a year in dividends, or $20 every month. The share price is currently at $20, so every month our dividend will buy us an extra share. That's 12 new shares every year, totally on autopilot. Looking at the stock price over the past 5 years, you can see the massive crash in March 2020 when businesses were shut down and the retail sector was decimated. It hasn't returned yet to those previous highs, but it is getting there. Now with rising interest rates and fear in the market, we're seeing a smaller but still significant slump of 24%, but it certainly will recover. Retail REITs are not dividend growth stocks like TD. The priority here is not long-term capital appreciation. We care more about that monthly passive income. But if you buy shares right now at this discounted price, we will earn great capital gains once the market recovers, in addition to locking in that higher dividend yield. For both of these stocks, make sure you are buying them on the Toronto Stock Exchange in Canadian dollars. always include the .to in the ticker symbol to ensure you're buying it on the TSX. These are Canadian companies, so there's no reason to waste money converting them into US dollars. And to actually buy these stocks, check out my referral link down below to sign up with QUESTRADE, my favorite online broker, and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up, and you'll help support my channel. And since these are purely Canadian stocks, you can also use WEALTHSIMPLE Trade. You can use my referral link down below to get a $25 sign-up bonus as well. And if you want to get the most of your investments, make sure you hold these in your tax-sheltered accounts, like your TFSA and RRSP, to avoid paying taxes on these dividends. To learn how to maximize your tax-free growth, check out my Canadian tax guide, my videos with the silver-colored thumbnails. So there you have it. Those are my top 2 all-time favorite dividend stocks in Canada. TD is my favorite dividend growth stock, giving me increasing dividends every year and long-term capital appreciation. It's the best of both worlds. RioCan allows me to dip into the retail real estate market and collect monthly dividend income. And I'm using this opportunity to buy both stocks at a significant discount. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube. And hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at CanadianTShirt, click my link in the box below or click the links on my homepage. Thanks, everyone, and I'll see you guys on the next episode of The Canadian in a T-Shirt. Bye, guys.